we've delivered another very positive half-year results. Just at the top lines, our profit before loan note interest obviously part of the distributions to you folks, up 14% to 139 million for the half, and proportional EBITDA without the interest, so after financing costs, up 7% to 306 million. So a good result. Distributions up 5% to 132 million. That's distributions to Spark. So that's thanks mainly to an increase from our Victorian Power Networks company and a first contribution from Transgrid in comparison to the previous half. Equity profits were up. That's largely due to South Australia Power Networks. The regulated revenue profiles for the 5-year period are quite unusual. It's due to the sculpting that the regulator has put in place, but it is as a result of the way that the regulator has been going through a number of reviews for the period. So we have moved from the first year, which was under the preliminary determinations, to the final determination. What does all that mean? Well, it means that we're recovering a lot more additional revenues over the remaining 4 years of the regulatory periods for the Victorian and South Australian business. What that means is the sculpting of the revenues over this period have been quite unusual. So the first year, the profiles, we saw quite a marked decrease in the tariffs, and now we're seeing the uptick. Now we're into the second period. So we saw about a 9% increase in the tariffs for the South Australian business, and we'll be looking to see about 3 to 4% increases about 3% increases in the South Australian business over the remaining 3.5 years of the reg period. And in Victoria, we had a net decrease in the current period, and we'll be seeing 4% increases over the remaining 3 to 4 years of the regulatory period for the Victorian business. So quite a sort of an anomalous period, a little bit one-off, but it's due to the sculpting. We recover all of the regulated revenues over the period. It's just the actual profile that you will see. We obviously try and manage those cash flows accordingly. All of the businesses have had a very strong eye on cost recovery, cost management over the period. So we've spoken a lot about the world-class program in the Victorian business. That's banked 151 million of savings across both CapEx and OpEx to the end of December 17, and there's been a further 27 million per annum of savings identified coming out of that program. That's quite common. You have a first wave of activity cost outs. You roll through, you implement those, you roll out the technology changes that are required for the harder to getting increases savings, and then you roll into the sort of second wave. So that's what we're seeing. In South Australia, Power Networks, they've launched their Powering Ahead program, so an equivalent sort of cost out program. They're targeting around about a minimum of $40 million of savings to come out of that business. Split obviously between OpEx and CapEx, probably a greater weighting to CapEx in relation to their savings. We haven't been upfront in terms of documenting the savings come out of the South Australian business, but they've estimated over the last couple of years that they've made savings of around about or over $100 million per annum. Transgrid is in a slightly different position in terms of its regulatory cycle. We are expecting the draft determination from the regulator actually at the end of this month, end of September. Transgrid has been continuing its efficiency drive. We've identified and implemented savings of about 9% per annum since acquisition, and there's a further 3% of savings to come through in that business, which we've been upfront in terms of our discussions with the regulator around the benefits of privatising that business, going from government ownership into public ownership into private ownership. Distributions, as I said, we've had to manage the distribution or the cash impacts from the regulated revenue tariffs. We look to sort of smooth that out as best as possible and calm all of those fluctuations. So we've been able to reaffirm our distribution guidance for 17 and 18, so 15 and a quarter and growing to 16 cents out in 18. So that continues that 5% growth. We haven't given guidance beyond 18. There's still a few unknowns, like the Transgrid reg determination. We'd like to see where that comes in. We are funding a lot of unregulated growth in the Transgrid business, which is very, very positive. And we're just working through the best way to do that. There's some anomalies in the short term in how we fund that. And of course, we're also got an eye on the inflation rate and where that goes. Over the longer term, we do expect our cash flows, etc., to grow at sort of CPI. We're obviously a CPI indexed stock, and that comes through in our regulated tariff. So that's sort of the target, if you like, or the benchmark that we have in mind in relation to revenue growth and hopefully then moving on to distribution growth. And we look to outperform. So benchmark is sort of CPI plus a premium. So you'll see that growth rate, not 5% going forward. I mean, that's a very difficult thing to achieve. 5% growth in a 1 to 2% inflation growth. That is very much reflective of where we've come from. In terms of regulation, South Australian and the Victorian Power Networks, they're as I sort of said, they're in year 2 of their regulatory determination, so they've got a lot of certainty for the next 3.5 years. And as I said, they're recovering those additional revenues that have come from the step from preliminary to final determinations. They are quite market those increases. So it was $180 million for Victoria, the step up between preliminary and final determinations that'll be recovered over the remaining 4 years. And the step up in South Australian Power Networks was $630 million. So very substantial numbers that you need to factor in. As I said, the Transgrid regulatory reset process, that's underway. The new regulatory period for Transgrid will come into play from 1 July 2018. So we'll get a draft in September. We'll see where that comes out. There'll be a response, etc. The final determination is due in April 18, and then that will come into play from 1 July 18. The Transgrid regulatory proposal does include a significant potential for CapEx, and we'll see obviously what the regulator determines in the draft, and then obviously in further discussions. There's quite a substantial program called Powering Sydney's Future, in the order of sort of $350 million. That is about reinforcing the transmission network and the supply into particularly Sydney, obviously, which has seen quite substantial growth. There's also a number of contingent projects in there, so contingent projects highly dependent on what happens in the external environment, but those contingent projects vary from sort of 500 to 2.2 billion in total. So they're projects like the interconnector from New South Wales into Queensland, the New South Wales SA interconnector, and obviously some augmentation of the network into Victoria. So very substantial one-off programs. So if Nathan asks me later on in terms of growth profiles, well, it really does depend in terms of what of those actually get approved and what of those get approved in the next 5 years. The Finkel and energy market, there's obviously been a lot of activity. The Finkel blueprint that came out earlier in the year was, I thought, a very good document, a very good roadmap of the future. Obviously, the federal government has said that they're implementing 49 of the 50. There's obviously a key one that they're still debating, and I think the whole market would like to get a bit of certainty on that one. The Finkel report, from our perspective, was very positive. It's really placed networks, especially transmission networks, front and centre in terms of being part of the energy paradigm going forward and how to deliver electricity in a world that is based around much more distributed renewable generation. So obviously moving away from the very large centralised fossil fuels, coal-based generation to a more dispersed renewable generation system. So very important role for transmission and distribution networks going forward and being able to deliver that. A good example is the Snubby Hydro 2.0 project that the federal government has announced, and in ensuring that there's firmer capacity into the national electricity market, the NEM. Transgrid is very much working with Snowy and the federal government in terms of the work required there. But again, that is potentially $1 billion program for Transgrid, depending on how it pans out. So quite lumpy opportunities, in addition to the organic growth that's also in the business on a smaller scale. We have included in the slides. I won't go to them, but they are in there about the pricing impacts on networks on the customer bills. There's been a lot of misinformation over the last couple of years, which has very much frustrated us. But the distribution network service providers' costs, or proportion of the bill in Victoria, it's around about 25%. South Australia, it's about 27%. If I compare that to what it was at sort of privatisation going back into the late 90s, early 2000s, it was probably mid-40s, the percentage of the bill. So quite a substantial reduction in absolute and relative terms. That's probably not what you've heard over the last couple of years, but it's a message that we've been strongly pointing to, that networks are part of the solution, but importantly they have to be efficient networks. And I think what you're seeing is a clear distinction between the efficiency of the networks that are privately owned and been privately run for a number of years versus the networks that are still in state government hands. And there's a few of those, obviously. We have also been front and centre in terms of talking to the Energy Market Commission and we're participating in the Finkel reviews and so on. The issue that we have around regulation is that it needs to change, it needs to evolve. It was built for a different purpose. As I sort of said, it was built for that time when electricity generation was based around coal-fired generation, and it was really transporting electricity one way from those major centres into the demand centres. We've now got a different market. Electricity is flowing bi-directional around different ways around the states, etc., flowing in different ways as the sun shines in certain areas and the wind blows in other areas. So it's a different different mix. And it's a different issue that the networks are being and need to be designed to cater for. So we're looking to engage and get the regulators to understand that they've got to evolve with that. Otherwise, you will see us looking to work more directly with customers to come up with sort of bilateral solutions.